But let's go ahead and start with original Medicare, because that's what you're going to get. If you haven't got it already, you should be receiving a red, white, and blue Medicare card in the mail. If you are concerned that your 65th birthday is coming up and you haven't seen one yet, you might reach out to your local Social Security Administration office, make sure that you are signed up and that information is coming to you. With original Medicare, you have two parts. Part A is your hospitalization insurance, and this helps pay for inpatient hospital stays, skilled nursing, home health care, hospice, other related services when dealing with admittance, or inpatient is a good way. Now, usually Part A is going to come to you at no additional cost, meaning that you're not going to be charged a monthly premium for this if you've paid taxes into. Rule of thumb, if you pay taxes for 10 years into Medicare, then you're going to get your hospitalization insurance at no additional cost. Part B, on the other hand, is your medical insurance, also known outpatient coverage, any medically necessary doctor's visit services, lab work, outpatient services, outpatient surgery, anything not admitted in for. With Medicare Part B, you are going to pay a premium for 2012. You will have a minimum premium of $99.90. There is a chance that premium could be higher depending upon your income level, and if you're unsure about that, you can always contact us and we'll explain where the breaks actually happen with the higher premiums for Medicare Part B. But ultimately, with original Medicare Part A and B that you will be receiving, you have insurance. You could actually stop right there, and as long as you understood your risks and you were comfortable with it, which most people aren't, hence why they look for insurance to help cover, you wouldn't have to get anything else. It's not suggested, but is an option. To help explain a little bit of the risk, here's a good chart. Also shows inflation throughout the year of different deductibles and out-of-pocket risks that you could be subject to if, and I got to stress this, if you only had original Medicare, nothing else. Your Part A hospitalization deductible. This is not what most people are used to when dealing with deductibles. It's not a calendar year deductible. It's actually what is known as a per occurrence deductible. Per benefit period, Medicare calls it benefit period of being a 60-day window for the occurrence that you say were admitted into the hospital, and you can see in 2012 the deductible is $1,156. Now, if admitted into the hospital, that should be your only risk unless you're in the hospital for more than 60 days. That's that benefit period, and as you can see, you have a co-insurance. If you're in the hospital for days 61 through 90, it's $289 a day. If you go past 90 days still in the hospital, not only does your daily co-insurance payment go up to $578 a day for days 91 through 150, but these are also considered your lifetime reserve days, and you only have 60 of them. If for some reason you've used up all your lifetime reserve days, you're in the hospital more than allowed, all costs are yours. Medicare stops per that benefit period. Same with skilled nursing care. Days 1 through 20, Medicare is going to pick up their approved cost. Days 21 through 100, you're going to pay $144.50 per day in 2012. After 100 days, all costs are yours. There's other scenarios like hospice co-insurance, first 3 pints of blood, but ultimately that is the risk that you're looking at for just your Part A or your hospitalization coverage when dealing with only having original Medicare. Part B, in my opinion, is a little bit easier to explain, but a little bit more of a risk. And what I mean by that is you can see that the Part B, or remember that your outpatient or medical services, is only $140, and this is annually, so in a calendar year for 2012. In 2011 it was actually $162 and actually dropped $22. But once this deductible has been met, Medicare will then pay 80% of its approved charges, leaving you with 20%, and if there's any excess charges, which we'll talk about. The reason I believe this is more of a risk is just due to medical technology, as well as A lot more services can be completed now outpatient, and with original Medicare you do not have a maximum out of pocket for a calendar year. In the insurance industry we call this a stop loss, a maximum out of pocket. Think of it as a cap of once you spend a certain amount, then the insurance kicks in at 100%. That doesn't happen with original Medicare. Example would be if you were to have $100,000 worth of outpatient chemo, you could easily pay $20,000, and again, still no cap. So original Medicare is insurance. It will take care of you inpatient and outpatient, but at these risks. So